It is 3 p.m. live from our brand new studio in New York City. I'm Julie Hyman alongside Josh Lipton. This is Yahoo Finance Live, and here's what we're watching this afternoon. A looming government shutdown again, and a big test for newly appointed House Speaker Mike Johnson. Lawmakers scrambling to pass a funding bill by Friday. Moody's lowering its U.S. outlook to negative, citing political polarization in Washington as a concern for the economy.
And the latest read on inflation, CPI out tomorrow. The Street expecting prices to decline in October, both month over month and compared to the prior year. Fed looking for more evidence inflation is coming down.
And retail earnings on deck. We'll hear from the likes of Home Depot, Target, Walmart, and Macy's this week. And we'll speak to an industry expert who will give us the winners and losers ahead of those reports. Let's get you up to speed on the market action, though, on this Monday. And we are seeing a little bit of selling, although not across the board here. Right now, we're looking at a mixed picture for the major averages. But really, let's, Josh, call it sideways, I think, here today. If you look at the groups on the move, industrials are down the most at the moment. Energy is up the most, but really, kind of muddling along.
Yeah, I mean, we're not doing a whole lot, which kind of makes sense because you have some key economic data out tomorrow. We just referenced, the latest CPI, and there it's interesting. So I think people are kind of waiting to see how that plays out. The rally we saw, the bump up, was kind of in part predicated on this idea that the Fed's on hold, they're on pause, they're done. But the data you're going to get tomorrow, that could help certainly kind of steer the direction of the market. Yeah,
there's been some interesting talk about whether we're going to continue to be driven by the CPI data or whether the focus is going to shift more to the jobs data and that's going to gain more prominence. I think we'll just have to see as we go through the next couple of months. But I think you're right. People are waiting for CPI. They're also waiting for these individual retailers to report to give us sort of a flavor for what effect those CPI increases, the inflation increases, are having on consumer spending right now, where it is starting to bite, where consumers are making tough choices, and if they are, right? So I think that's going to be important for investors also.
Yeah, and I think also, listen, I'm sure some technicians or strategists, even if you think the market's moving higher, you may be thinking we're kind of due for maybe a bit of a breather, a pause here. I mean, some of the names, the moves you've seen, some names, Apple's up 8% this month. That's a big move. So even if you were looking for some move higher, maybe you're thinking, okay, maybe there's a point here we can consolidate a bit.
Yeah, I think people are asking the question, do they hold back before the end of the year or do they dive in at this point?
Well, we are not even halfway through November yet, but major investment groups are already rolling out their massive outlook documents. This year, investors paying extra close attention to forecasts for the Federal Reserve. We heard from Goldman Sachs, UBS, and Morgan Stanley, and the big banks did not seem to agree on what exactly we could see from the central bank in 2024. Our head of news, Miles Udland, joins us now to help us make sense of it all. Miles, make sense of it.
Thanks for having me in your new house. This is wonderful. I think as you would perhaps expect, you're seeing some divergence on the street in terms of what folks think is going to happen next year when it comes to Fed policy. But I think really the important thing is that for next year, this is the prediction that most people are most focused on. Usually we're sitting here talking about what else is coming out this time of year, which is 2024 S&P 500 price targets. And I know we can get into it with what Mike Wilson at Morgan Stanley said earlier today, but this year's main event is where economics teams see interest rates going. And as you mentioned, Josh, this morning, really the headlines coming from UBS out saying they're looking for almost 3 percentage points worth of cuts from the Fed next year, 275 basis points of what they're looking towards. But as you look at this graphic here, you can see Morgan Stanley, a little more conservative, 100 basis points next year. The Fed itself is looking for 50 basis points in rate cuts next year. That's as of their September forecast. Goldman doesn't see any action until the fourth quarter, so could be September, November, December are going to be, or really November, December are going to be your options there. And then Barclays, they actually think there's going to be a rate hike in January 2024, and that will end 2024 at the same levels we are today, with rates in a range 5.25% to 5.5%.
Is there usually this much divergence in this kind of stuff?
Well, I think for me, it's usually we don't pay that much attention to it. I think for two reasons. One, the Fed itself puts out forecasts on where they think rates are going. So every investment bank is going to have their little, change on the edges of it. 25 basis points more or less than what the Fed says. But because the dot plot exists, and we'll get an update on that next month, there's no need to focus too much on where Wall Street economists forecast rates to go. And those economists don't spend too much time themselves thinking about it. They're like, we'll follow the dots and we think they'll be more or less conservative. And I think the other thing is we are clearly at an inflection point for Fed policy, which is not always the case. Most years, you have a pretty good idea of, rates are probably going to go a little higher next year or a little lower. And though everyone agrees that the direction is lower from here, the speed at which it happens, why it happens, there's going to be a shift in how we all think about what role the Fed plays in markets and the economy next year, and you can kind of see it coming from this distance.
What do you make of Mike Wilson at Morgan Stanley in particular? Because this was a well-known skeptic, we know that of Mr. Wilson, says, all right, he expects about 12 months from now, the SPX, the S&P 500, to end 2024 at 4,500, so not a whole lot of upside there.
Basically flat.
Yeah.
I think what was interesting about Mike Wilson's note is, so stocks flat next year, fine. I think there's a lot of skepticism right now that the earnings forecast for next year will stop coming down. So if you start to see earnings per share forecast for 2024 continue to come down, it makes sense that markets will be flat. What you and I were chatting about before this, Josh, is that Mike Wilson's calling for 16% earnings growth in 2025. But the number one thing to me, at least, and I think some investors would disagree, but to me, the number one thing that matters for stocks is that year ahead of the year ahead earnings forecast, right? Like why stocks have gone up this year is because 2024, second half of 24 outlooks are coming down less than expected. Therefore, it's good, right? So you should keep buying stocks. So if we're going to say that 2025 is going to be almost 20% earnings growth, it's not clear to me why necessarily that wouldn't start getting priced in 2024 unless Mike just thinks we're going to start from a lower base. Are we going to be down 10, 15% from here come January, and then you get yourself back to level, then you do the rest? I mean, we can do all these mental twists, but to me, that 2025 earnings outlook says higher stocks in 2024.
I mean, doesn't the Morgan Stanley economic outlook imply a worse scenario than some of the other banks?
Yeah, I mean, I think to me, and this is what I'm struggling with as I write about this and as I think about this, is like you get to rate cuts from the Fed in a couple different ways, and the way you get there matters a lot for the stock market. If you get rate cuts from the Fed because inflation comes down, you have this soft landing, right? Then yeah, you're definitely going to see higher stock prices. That's going to be good. All else equal, lower interest rates, higher stock prices. If it's because of a recession, well, then we get into all the numbers around what happens to earnings in a recession. Typically, they're down by 30% peak to trough. I am struggling to see why you would have even a flat market next year with earnings coming down 30% from peak to trough if we are indeed tipping into recession. And so I think at the heart of these disagreements from these firms and kind of that outlook we had on where the Fed goes next year is really a disagreement about, do we have a recession? And then if we do, what's the magnitude of that recession? Because clearly, you look at what Goldman has said, what Barclays said, they are not really looking for a recession next year.
Right. I mean, the divergence seems to me to be rooted in what we've seen this year, which is everyone was wrong, right? And so if you're a strategist, whether on the equity side or on the economy side, and you look at what's happened this year, you got to be taking a good hard look at how you try to forecast this.
I mean, there are a lot of folks that we are reading a lot here at Yahoo Finance and we're quoting and talking to, and it's like, it continues to be, well, it will happen just in the future, right? There will be a recession for all these reasons. Consumer excess savings come down, yada, yada, yada. We talk about this a million times. And it's just not clear that 6 quarters into that argument, we need to say, well, just wait a couple more quarters. And I do think, to your point, Julie, I think the street is struggling with that in their outlooks. And look, it's very conservative how they're written, very staid and all these things. But like, you can tell if you read this stuff enough and for long enough, as the three of us have, you can see there's a real struggle on the street with like, how do I make sense of something that has not really made sense in, God, we're going on the 4th year, right? This is gonna be the 4th year post-pandemic of trying to figure out, since COVID started, of like, how do we think about this? I don't think anyone has a good answer.
All right, Miles, thank you for joining us today. Appreciate it. Let's get some tickers now. Shares of Boeing, they are trading higher today, almost 5% there. That's after Bloomberg reported China may end its freeze on the purchase of the airliner's 737 planes. The announcement could come out of Biden's meeting with Xi Jinping this week. So actually, there's a couple points here, Julie. So one, it's the Dubai Air Show, which is going on right now. That always means orders and headlines. And so that is what we're hearing now. So Emirates announces an agreement for 90 of Boeing's biggest aircraft, reportedly a list value there of $52 billion, including to purchase an additional 5 787s. And then top of that, what Bloomberg is reporting is more Boeing news that Beijing is considering unveiling this commitment for Boeing's 737 jetliner.
Yeah, exactly. And as you said, all of this is happening at the Dubai Air Show. And typically you have sort of this competition, right, at all of these air shows. The Paris Air Show, the Dubai Air Show, all the air shows you have between Boeing and Airbus. And this competition for orders, who's going to get the orders, who's going to get more first. And Boeing really coming out of the gate here and seeming, this is not to say that Airbus won't end up getting a significant number of orders, but Boeing seems to have taken an early lead here. And Boeing needs some wins, right, to be clear, because they have been having still some troubles with some of their aircraft. Spirit Aerosystems, which is one of the main suppliers for Boeing, also seeing a pop today because it too needs some relief because there's been some quality control issues with some of the parts it's been supplying to Boeing. So, part of this is also relief that Boeing is solidifying some of these orders.
Yeah, it looks like people, analysts on the street, they expect a win here. I mean, there's a lot of love for Boeing. Stock's only up about 8% this year, but more than 70% of analysts covering Boeing think you should own this one.
All right, well, some people are taking that advice. All right, let's talk about Henry Schein as well. Those shares are also higher. They reversed earlier losses from the company's third quarter revenue miss and lowered full year guidance. Now, when you look at the turnaround that we saw in the shares today, right now they're up by 6%. It's true if you look at the $1.32 earnings per share here, that was below or at least in line with what some analysts were expecting. One of the analysts who was expecting a little bit less from the company was Stifel's Jonathan Block, who did come out with an outperformer, a buy rating on the stock, saying that the multi-year headwinds on the company are abating. One of the things that's been affecting Henry Schein, there was a big cyber attack on the company. Block says he feels like they are starting to come out of the other side on that.
Yeah, so I mean, you did see this reversal today. It was down, now up. Q3 earnings in line, sales missed, lower 2023 guidance. But I think in part here, too, you can hear the company executives and the way they were talking about the quarter when they talked about things like, despite macroeconomic conditions, despite that cybersecurity incident, they said we have confidence in the stability of the dental and medical markets. Of course, investors like to appreciate that word very much, stability. And that note from Stifel, as you noted too, they think that cybersecurity impact may prove transitory, past structural headwinds, they say. Looking in the rearview mirror in the business transformation, they told their clients to higher margin products continues.
Yeah, and also the perspective is the stock's down this year, as we've been showing.
Yep.
So a bounce on the back of that.
And finally, let's get a check on shares of Novo Nordisk trading higher today, it looks like. Company got some good news over the weekend about the benefits of weight loss drug Wegovy. Yahoo Finance's Anjali Kamlani has that story for us.
That's right, guys. We know, of course, that we expected some results from the initial announcement from Novo Nordisk about this, but we got some more information at the American Heart Association event over the weekend, and that includes a 20% reduction in risk for cardiovascular events. That includes the things like stroke. And that really has boosted the company's outlook for this, but it also, as a side note, benefits Eli Lilly. And that's because their anti-obesity drug, newly approved Zepbound, also falls in the same category. So it's really boosting everything in the class. As we know, GLP-1's really on a tear here this year because of all these additional benefits that are being looked into. And the first proof of that, now this isn't the first time that we know a drug like this has had additional benefits, especially when it comes to weight loss and diabetes, but we're starting to see these really good numbers. It does look like analysts did have a little of this built in, so this is not necessarily surprising, but definitely some good news all around.
What is surprising is when I look at medical device makers today, because a lot of these companies, when we've had prior news about these drugs, have plummeted because there was concern, oh, you're not going to need to test your insulin anymore if everything's cured, right? But they're actually moving higher today.
That's right. So on the plus side, we know that this drug works, but on the minus side, we know that this required 3+ years of treating, and the absolute reduction of the risk was only 1.5%. So it's a very small percent compared to the overall treatment group. And so that really tells us the story of you have to be on these drugs for a long period of time. That's a concern that the companies have had, that healthcare payers have had, right? Insurance and the like. That's why they're sort of standing back and trying to see if they don't necessarily have to cover the drug. But this helps push the envelope for coverage, so that's the positive. But everyone else is looking at this going to your point of, this will affect all the other industries. We know that glucose monitoring actually does get more uptake as a result of using these drugs. So all of this is coming out as any kind of end of world scenario that we kept hearing earlier on. Some of that is panning out to be actually the opposite, because this is encouraging more use of whatever it is in a different way.
It's a good reminder to kind of take a step back and wait for more information before maybe making some of these snap judgments or snap trades that we've seen on some of this news.
Absolutely.
Yeah. Thank you so much. Appreciate it. Well, the Santa Claus rally started early this year, you could say. Trading in the options market could be the tailwind needed to end 2023 on a high, perhaps. Traders have been loading up on call options amid the upswing that kicked off shortly after September's jobs report. Calls, of course, allow investors to capitalize on the upside if a bull market really takes hold. In short, buying shares at a specific price sometime down the road. Right now, there's a lot of talk on the put-call ratio. This effectively tells you the difference between contracts betting on gains versus those betting on losses. So what is the right way to be positioned amid a series of economic and geopolitical risks? Let's bring in Joe Mazzola, Charles Schwab, Director of Trader Education, for our Options 101 segment brought to you by Tasty Trade. Joe, thanks for being here. So first of all, let's take a step back here. What are we seeing in the put-call ratio here? What are we seeing in the VIX, of course, which tracks options, that tells us about where sentiment is right now and where the market could go next?
Sure. So I think let's start with the VIX first. So the VIX came down to around 14. Now it's a little bit above, 14 and change, 1420 or so. A big move down from the 20s that we saw just a couple weeks ago. A lot of it had to do with the fact that, we got the interest rate reprieve. We had a lot of people from the hedge fund world that were short bonds kind of heading into the Fed announcement and heading into the Treasury financing announcement a couple weeks ago. They got caught on the wrong side of the trade. Markets rallied, bonds rallied, interest rates came down, and you saw a lot of that pressure that was kind of built up into the options market from the volatility side. A lot of that could be attributed to what we were seeing on the interest rate side. Once interest rates pulled back down to that 4.6 range, you saw the implied volatility come out of the options market rather precipitously to where we're at right now. Could be an area where we consolidate a little bit in terms of volatility. You talked about the put-call ratio and what we're seeing there. So it depends on what you're looking at. One of the things that I keep an eye on is the SIBO equity put-call ratio, because that tends to be more of the retail trade as opposed to the SPX or what you would see with more institutions. So on the SIBO equity put-call ratio, you're still actually seeing it above 1, which is interesting because that means that there's still a decent amount of hedgers out there. Not to the same extent when you would see 120, 130 or so, but there's still a decent amount, which to me means that even though you're seeing some call buying, it doesn't look like it's overdone at this point to where it would be kind of screaming everybody's on the same side of the trade.
And Joe, I'm interested in what you're seeing in tech too, because you've seen some big names make some big moves. I mean, Apple's up about 8% this month. When you look at the Nasdaq, Joe, what are you seeing there? What's the trade?
So this one's to me is really interesting because you got to break out from that downtrend that really started from the July highs. Broke out just a couple days ago, and we had a retest last week when we pulled back on Thursday. Retested, held, and it's really moved up. Even today, it's kind of unchanged a little bit in the Qs. But what I noticed is if you look at the candles look pretty strong in terms of that breakout. So when you're looking at a trade like that and volatility's low, that's why you're probably seeing a lot of people buy some of these tech calls for that upside move into the end of the year to see if that Santa Claus rally holds.
And just for folks who aren't familiar, when you're talking about candles, you're talking about the daily highs and lows. So if stocks continually close closer to the highs of the session, that's seen as a pretty good sign. So Joe, when all is said and done, what are you recommending that folks do here if they want to try and at least in a hedged way take advantage of potential upside?
Yeah, so that's a great point. If you went out and bought, let's say the Nasdaq, whether it's the Qs or something like that, if you're going to buy 100 shares with the Qs trading around 377, you're talking $37,000 just to kind of own those 100 shares. Another way that you could participate in the upside is by buying something like a called spread. And the way that I look at call spreads is I think of it, I try to make it as easy as possible. I say, where are we at versus where do I think we're going? And a lot of times that breakout helps. So if you get that breakout from that downtrend, you can look at that measure from the top to the bottom of that downtrend, and that can potentially give you maybe an upside target. So what I was looking at in this trade, it was the Qs. It was looking at the December 15th expiration, 375, 390 call spread. So I know that those 375s are a little bit in the money already. That's okay. I like to have a little bit of in the moneyness on this trade. It reduces some of that time decay, gives me a little bit more delta. And if the market does rally, instead of now paying $37,000 to own 100 shares of the Qs, at this point, we can control those 100 shares from 375 to 390, participate in that upside move. If we pay about $7.20 on the spread, which is basically where it's trading right now, you're talking $720. So it's a way for you to actually have a little bit more leverage involved as opposed to just owning the shares outright.
Right, and spending less to do it, it sounds like, too. I like that in the moneyness. Joe Mazzola, Charles Schwab, Director of Trader Education. Good to catch up with you. Thank you.
Thank you.
We're just getting started here on Yahoo Finance Live. Coming up, retail earnings on deck. We'll get a check of the consumer and a preview of what to expect from the retailers like Home Depot, Target, and Walmart. And S&P rally. Equity's seeing a nice bump of late, but can it last? We'll get a read on your portfolio. Plus, a looming shutdown. Congress has until Friday to pass a funding bill. We'll get the lowdown on what to expect after this break.
A U.S. government shutdown looms for the second time this year. Congress has until November 17th before funding is set to expire again. New House Speaker Mike Johnson out with a two-step temporary funding proposal to avert a partial shutdown. Meanwhile, Moody's sounds off warning bells with its outlook on the U.S. credit rating, lowering it to negative from stable, citing large fiscal deficits and a decline in debt affordability. So where does this looming shutdown place the country's fiscal situation? Here to discuss this and more is Strategas Securities Managing Director Jeanette Lowe. Jeanette, thank you so much for joining us.
Thank you for having me.
So bottom line, Jeanette, listen, investors want to know, Speaker Mike Johnson, he has this plan. He's going to put it forward. Do you think, Jeanette, it's going to pass and we're going to avert this shutdown? Because it does sound like he is catching some heat from some members on the right for this.
Right. So he is getting some opposition from some conservative members within his caucus to his two-step plan. So this is going to create two funding deadlines, one on January 19th and a second one on February 2nd. But overall, we do think that this bill will pass if they actually get it to a vote. Now, the problem is that we do have two procedural steps that come in between there. We do have the Rules Committee meeting today at 4 p.m. That is usually a partisan vote. There are 3 conservative members on that committee that need to move it forward, but it could be that we have Democrat votes come in instead to help that move across. And then the full House actually has to pass that rule as well before we can get to an actual vote on the continuing budget resolution. So I just think that we need to be careful that there could be some stumbling blocks in these procedural votes before we actually get to the final vote. But if we do get to that final vote, we do think that it'll pass and that we can avert a shutdown at the end of the week.
So let's assume, Jeanette, that we avoid the shutdown, the government stays open, everything is fine, but everything isn't fine, is it? I mean, you've got all the credit agencies now pointing to this consistent dysfunction in Washington as a problem. You have, the increasing drumbeat of the fiscal house of the United States being perhaps in jeopardy. Debt servicing costs are going up. The Treasury has to issue a lot of debt. What's the big picture here?
Right. So when we were looking at the potential for a government shutdown on October 1st, we were thinking about the fact that Moody's had been saying that they could put the U.S. on a credit watch if we went to a government shutdown. We obviously did avoid a government shutdown on October 1st. We haven't reached a government shutdown here, but Moody's did and still put us on a credit watch. So that is one step closer to a credit downgrade. And of course, Moody's is the third of the credit rating agencies that is yet to do so. So what we're looking ahead to is that this is a huge change in the U.S. fiscal picture. So for the last 25 years, we've had a fiscal policy tailwind. Congress has been able to raise taxes or cut spending, and we haven't really had to worry about debt servicing costs. But with the Fed having to fight inflation, having high interest rates has led to really high debt servicing costs. And we are now looking at debt servicing costs nearing the amount that we spend on defense spending. So this is really taking up a big chunk of the budget. It's going to start to squeeze out other spending levels. And Congress is starting to look at this and starting to think about how to manage it. But most policymakers haven't really had to worry about this. And it's going to be a real change for the fiscal policy for the country moving forward. Now, we think that Congress may not do anything before the 2024 election, just because this is kind of the norm in Washington to focus more on getting reelected rather than kind of taking those tough decisions to bring the fiscal house in order. But what we've been focusing on is that net interest costs have reached 14% of tax revenues. They're now actually at 15%. But historically, what we found is that once you reach that threshold, the fiscal environment moves from one of stimulus to one of austerity, and that's going to make a big difference going forward in the years to come.
And austerity is not something we in the U.S. have faced in quite a long time, Jeanette. So, even if it doesn't happen before the next election, what are the implications for investors? What do they need to pay attention to? And what effect could it have, I would imagine, particularly on the Treasury market?
Right. And so one of the things that we've been finding so interesting is that Treasury has been making a lot of changes with how it's been financing its debt. And that's been creating some moves in for stocks and for bonds that's been important to watch for. The Treasury has now decided to move more of its financing its debt on the short end of the curve. That was a surprise that may have even taken Moody's by taking them aback a bit, that we're now seeing no clear movement from the Treasury as to how they're actually going to finance this debt. And so that's something that's going to be important to look forward. One of the other things that we're watching is Congress does still want to do this $100 billion supplemental funding package that the president has proposed. So this is to provide aid for Ukraine, aid for Israel, for Taiwan, for the southern border. This still may be on the table, even before we get a budget potentially in January. So this is something that we need to watch out for, and how the bond market reacts to having that big of a stimulus coming into the market could have a big impact on bonds going forward. And that's something else that we're going to be watching out for. But then I think one of the other things to kind of start to think about too is what's going to happen with taxes and spending over the next couple of years. So we do have a number of tax cuts on the individual side that will be coming due at the end of 2025. Who is in office at that point will be really important. And that's going to be something that the Congress is going to have to say, okay, can we keep these tax cuts in place? Do we need to pay for them? How are we going to do so? And there's going to be some tough decisions that are ultimately going to have to be made.
And Jeanette, last question. I just want to touch on a point you just brought up there, the aid to Israel and Ukraine. Jeanette, how do you see that all playing out given this drama on Capitol Hill?
So that is a tough one right now. I think one of the things that's really been important from the Republican side is they have said that they cannot move that supplemental forward until there is an agreement on having more security and not just funding for the southern border. There is a bipartisan group in the Senate that has been working on that. If they are able to come to an agreement on actually putting in some proposals to reinforce the border, to make it more difficult for migration through that border, that is what could be the impetus to actually getting that supplemental bill passed. But in the short term, we're currently looking at a continuing budget resolution that is not including any aid for Israel or for Ukraine. So we need to see if there can actually be some compromise in order to move forward. But then we also do have to think about that there could be some challenges because we're asking for a lot more spending without any offsetting budget cuts at this time.
Jeanette, really helpful insight and perspective as always. Really appreciate it. Jeanette Lowe.
Thank you.
Well, with the 2024 presidential election just under a year away, AI experts are sounding a warning about the potential for a massive upswing in misinformation. Major players in the space have pledged to follow strict rules on how the tech can be used. But one expert, Darrell West, says voters should brace themselves for a tsunami of disinformation. Yahoo Finance's Dan Howley has been following this. That sounds scary, Dan Howley.
Yeah, it sounds scary. Essentially what's going on here is, this is the first election, general election obviously, but first, major election where generative AI is widely available. And so, some of the experts that I spoke to recently with regards to generative AI have said that, look, this has democratized this kind of technology to make it readily available for anybody to get access to. And so, that is a good thing. People can do things like code using this. They can do things like create images or videos or help them put together emails. The flip side, though, of that is people who have bad actors can put together images of Joe Biden falling down or Donald Trump getting tackled by police. Remember, we saw images like that crop up prior to his arraignment. We'd also seen what's reportedly an AI-generated image of an explosion outside the Pentagon earlier this year that had sent stocks plummeting for a short period of time before the Pentagon said, there's no explosion. Why? We don't know what you're talking about. And so these kinds of issues are just going to continue to crop up. And it kind of behooves social media companies, this is the other element of it, to be on top of that and recognize that these are going to be an issue moving forward. Unfortunately, they've pulled back on some of those protection efforts as of late.
And Dan, so when you talk about this kind of fake imagery, fake videos, that's been a problem for a long time. Is the issue just that AI, it just means you can create this kind of fake video, fake imagery that much more cheaply and quickly? Is that the issue?
Yeah, you don't have to be an expert or anything. You don't need to know how to use any kind of photo editing tool. You can be, a jerk like I am and just go in there and, write something up and it'll spit out an image for you, right? I mean, I could put something like dog on the moon with flowers and it'll show me, a dog on the moon with flowers. So, you can do things like this. A lot of the companies, Microsoft, Adobe, a number of others have blocks in place. I was trying to make, images of Trump and Biden, and it would repeatedly bring up that action is blocked or something along those lines, stopping it. So there are kind of roadblocks in the way to prevent that, but that doesn't mean that others won't be able to use different forms of generative AI to take advantage of this. And so it really can just come down to the sheer amount of nonsense we see. The problem is, yes, we've seen phony images forever, right? Phony stories forever. The problem, though, is that the huge amount that we could see this election will essentially poison people as far as actual news goes. They'll be on social media and say, you know what, forget it. I don't know what's real anymore. I'm just not even going to pay attention. And then that makes them pay less attention to what's actually going on, the real issues that matter and could truly impact them. So it's the scale at which this can all spread so easily because of this technology.
All right. Dan Howley, thanks so much. Great to have you on set.
Thank you.
Great to
I
see
like
you.
it.
All right, coming up, S&P rally. We're going to break down how investors are positioning in equities ahead of the end of the year. That is coming up next. $2024 can't come early enough for Wall Street. Two analysts are increasingly finding themselves on the same side of the market. Morgan Stanley's Mike Wilson is sounding less bearish than usual, expecting near-term uncertainty to give way to an earnings recovery. Meanwhile, Wedbush Securities tech bull Dan Ives is expecting a tidal wave of artificial intelligence spending. Yahoo Finance's Jared Blickery is here to break it all down. Jared.
Yes, thank you. Two different very forms of analysis. Mike Wilson from Morgan Stanley out with his 2024 chart book. Miles Udland of Yahoo Finance was talking about it earlier, that 4,500 call for the S&P 500. But I want to dig into some of the individual stocks that they're talking about. And for the most part, Mike Wilson is talking about defensive stocks and also quality growth stocks and a few others, late stage cyclicals. But what I was honing in is the area of his report where he's focusing on artificial intelligence. And that's where there's some jiving with Dan Ives over at Wedbush. So first thing I want to point out, and I'll get back to this in a second, I want to point out that the mega caps that we've been talking about this year have been in full force, and they're expected to continue that dominance into next year. This is what their earnings net income is looking like for 2024, and this is how it has tracked the entire year of 2023. So we have the Magnificent Seven in purple here. That is that line that started rising about mid-year, actually just before May, at the end of the end of the internet banking panic. And then we have the S&P 493, and this has been steadily trending down, and that has been a trend that we've seen all year. Next year, expecting AI to be able to take advantage of a lot of these trends, But there are some near-term headwinds, and this is something that Mike Wilson is talking about. Macro risks are being discussed on calls. This is a chart that goes back about 20 years, and there was a lull over the last few quarters in these macro risk sightings, but they have turned back up. So there are some headwinds on the horizon. Now, let's get back to those stock picks or stock screens for AI that I should call Morgan Stanley looking here. You're going to notice that a lot of these involve mega caps, and that's no surprise. That was the basis of a lot of their outperformance this year, which is expected to continue into next year. But we have some others as well. And by the way, this is reflecting year-to-date performance. So besides NVIDIA, Meta, and the others, we have MongoDB, CrowdStrike, AMD, not NVIDIA, Adobe, for instance, and also Intel. So a lot of software and chip stocks that aren't necessarily huge as these mega caps. I'd also add that 5-9 down there in the red, kind of an outlier, maybe a bit of a head scratcher. Now, you compare that to Wedbush's stock picks in AI, we're going to see a lot of overlap here. Not only in some of the stalwarts, like some of the bigger ones like Alphabet, Apple is there, Datadog, we remember that, Palo Alto also there, CrowdStrike, so some overlap between the two. Finally, I just want to close with Morgan Stanley's healthcare AI screens. This is something that's really interesting since it is Healthcare Week here at Yahoo Finance. I thought I'd give this a whirl. Now, not all of these stocks are in the green for the year. In fact, a lot of them are in the red. Nevertheless, Morgan Stanley is expecting a lot of these to outperform. And you might notice on the list, nowhere do you see Eli Lilly. That is one of the best healthcare stocks of the year, but it has nothing to do with AI, so it didn't make the list.
So interesting, Jared. The AI, we haven't talked as much about it lately, but obviously still very much a part of the thesis for these various firms. So we'll keep watching those. Jared, appreciate it. Well, the recent rally in the S&P 500 is investors wondering about increasing equity positioning heading into the end of the year. But our next guest has a warning for investors. Don't get too bullish too quickly. For more on what's behind the caution, we turn to Stephen Mulholland, CEO and founding partner of Mulholland and Cooperstock Asset Management. Stephen, thanks for being here. So we have seen some chatter about enthusiasm going into the end of the year. What gives you pause here?
So you guys are doing a great job on this show, actually teeing up all the important variables. You had Janet on just a little bit ago who was talking about the government issues, and that we'll probably get through this week's issues, but that remains firmly on the table. There is one economic forecaster. It is very difficult to find a good economic forecaster. The one that has a good track record that I follow is Bill McBride at Calculated Risk. Back in 2013, he laid out 3 likely causes of a U.S. recession. In descending order, they were number 3, something like a pandemic. Unfortunately, we experienced that. Number 2 was a government mistake, like a government shutdown or not paying our bills. That's very much on the table. And number 1, the most likely cause of U.S. economic recessions is when the Federal Reserve raises interest rates to cool the economy when inflation appears. And that certainly remains the environment that we're in today.
And Stephen, when you say less cautious, are there, looking ahead, are there certain metrics or variables or indicators, Stephen, that you're watching to know when you should become less cautious and more confident?
Absolutely. And we got through Halloween, so the ghosts and the zombies are past. But I do think the episode of 2008 still has important lessons for us. So with the S&P's rally of a little more than 5% in November, coming after the 3 months prior that were all negative, the S&P all lost money, the 5% rally was enough to trigger 2 of the 3 trend indicators we use in the algorithm at Mulholland and Cooperstock Asset Management to guide asset allocation. Our recommended S&P 500 exposure went from 0 to 33%, and it's not too far from 50% just on trends firming up. But the first thing we did when those trends turned positive was looked at the 2008 episode, and sure enough, there was a bit of a head fake in the second quarter of 2008, where the S&P also rallied sufficiently to turn both of those indicators to positive. Of course, 2 months later, those turned negative again. Lehman Brothers and Bear Stearns took over the headlines, and the S&P fell precipitously from there. So it's a great question. Also, a bit ominously, In 2006, 7, and 8, the Federal Reserve discovered they were behind the curve and attempted to raise interest rates to make up for their past mistakes. They stopped at 5.25%, 5.5% on the federal funds rate, which is exactly where we are today. The key difference is this time we rose from 0, where in 2006, 7, and 8, we rose from 2%. Connor Sin at Bloomberg just wrote a good article that said, hey, if the Fed cuts rates by 0.5 point, maybe we can forestall a weakening economy and a recession. But that's exactly what happened in 2008.
I mean, Stephen, there are some also other pretty substantial fundamental differences between now and 2008, though, too, right? I mean, like, we don't have, one could argue there are cracks on the margins in the system, right? But you're not seeing the kind of meltdown in underlying credit, for example, in the mortgage market that we saw then.
No, absolutely, and great point. And every crisis or every crash of the market is always a little bit different, right? 2001, 2008, COVID, 2020. Hopefully, we have nothing like that anytime in our lifetimes again. The similarities are coming from the market, what the bond market's been doing, how it told the Fed it made a mistake, and now the Fed's trying to catch up. The trend indicators of the S&P 500, how the market is overvalued and making it vulnerable. So to your point, thankfully, there's nothing on the horizon like the hidden danger of credit default swaps and subprime mortgage-backed securities. The difference this time is we had 0% rates for 12 years. So ultimately, all of the houses in America, the public stock in America, private equity, cryptocurrency, which didn't exist then, we overinflated a lot of assets that, whichever one of those you look at individually, are still overpriced somewhere in the 10 to 30% range. So this time we don't have a singular risk, thankfully, like what you highlighted from 2008 in terms of what was hiding in the bank balance sheets and off balance sheet, but we have a more widespread inflated asset prices. So Treasury bills went from 0 to over 5% in terms of yield or expected return. The 10-year bond bottomed at about 50 basis points in COVID. Thankfully for savers, that's about 4.5% today. If you pull up Vanguard's expected return for the S&P for the next decade, it's still about 4.7 per year for the next 10 years. So we could certainly have an environment. So since 2021, when the Fed raised rates, investors have gotten no return for the S&P. If we keep that up for a few more years, we could grow into the more normal 10% expected rates of return on the S&P, which, by the way, that's Bill McBride's forecast for real estate. Is home prices got so expensive from California to Austin, Texas to New York that will just grow with inflation for the next decade until we get the next demographic shift. So we don't necessarily have to have a crash, but using the tools that have shown efficacy in the market, trend and valuation, on a valuation model, the ones that have predictive power, we like to use the error term from models that have predictive power. So not what is the CAPE forecast for the next 10 years, but what did the CAPE or price to sales or market value to GDP, what did they forecast 7 or 8, 9 years ago? Well, the S&P overshot those expectations. So it would be logical, and like we've experienced for the last 2 years, for us to undershoot to get back into averages. So on valuation, we still deem the market that it has to fall about 20% to get attractive. And then in terms of trends, personally, I was comforted when the trends turned positive. Hey, maybe the market knows something, maybe things, maybe the soft landing that the Fed always goes for this time will work. But the parallels from 2008 show hope died hard in 2008 too. So for our investors that own the MCAM ETF or where we use that as part of the asset allocation, we've certainly increased our S&P exposure, but I would say nervously so.
All right, we'll stay watching. Stephen Mulholland, thank you, Stephen, so much for your time and insight today. We appreciate it.
Thanks, guys. Likewise.
And coming up, retail is on deck. It's a big week with reports from Target, Home Depot, and Walmart. We're going to break down the possible winners and losers. It's coming up next.
Good morning. morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Members of Starbucks Workers United plan to strike at Starbucks stores on Red Cup Day, November 16th. Union also calling on customers and allies to lead actions at Starbucks stores in their communities in solidarity with the union's Red Cup Rebellion. Here with the details is Yahoo Finance's Brooke DePalma. Brooke.
Good afternoon to you both. That's right. The Red Cup Day is supposed to be a day of celebration, a promotional day for Starbucks to really kick off their holiday season. And now what this is turning to is yet again another day of a national strike that Starbucks Workers United is calling for. And ultimately what this is when Starbucks customers come in, they get that reusable red cup when they order a fall or holiday drink. And then when they bring that cup back, they get 10 cents off or 25 bonus stores. Now Starbucks Workers United is calling unionize, or rather vote those stores that voted to unionize and other stores to strike and walk out, demanding that Starbucks turns off mobile ordering on these future promotion days that they say lead to both employees and customers overwhelmed and with long wait times. Now, I did just speak to a Starbucks spokesperson who said that they are aware that Workers United has publicized a day of action on what they say is a small subset of U.S. stores. And in a statement to Yahoo Finance, they said that out of the last 2 national strikes that the union called for, Starbucks has kept more than half of the stores opened that participated, and we anticipate that will be the same this year. Now, they said that out of the stores that do participate, it's typically about 1 or 2 employees that take part in the walkout. And so they're able to keep the store operational in some sort of capacity, whether it's doing just mobile ordering or just drive-through. But what's interesting here is it really is a two-sided story. Starbucks says that Workers United hasn't agreed to bargain since June 14th, but Starbucks Workers United saying that the company refuses to come to the table. And so lots of fallout here.
Yeah, I mean, and just like we saw with the auto workers strike, what they're trying to do is make things painful for Starbucks. I mean, they have 9,000 workers who are now represented by Starbucks Workers United.
It's roughly 300 in some stores, and so it's definitely a two-sided story here. But Starbucks did tell me that they have made some recent progress on negotiation with Teamsters for a store in Pennsylvania, and 3 contracts recently ratified with the United Steelworkers for stores in Canada. But Starbucks continues to believe that a direct relationship is best. So we
of course they do.
But this sort of went into the backside. This went into the backside. We haven't heard from them, from anyone, in quite a while. So it'll be interesting to see just how big Thursday is.
Yeah,
if it's what Starbucks isn't expecting or what Starbucks Workers United is expecting.
Yeah, most definitely. It'll be interesting. We'll count on you to keep us posted.
Absolutely.
Brooke, appreciate it. Well, it's a big week for retail. We await the monthly sales report and earnings from some of the big box stores like Walmart, Target, and TJ Maxx. All are expected to give us insight into the state of the consumer ahead of the all-important holiday shopping season. Here to help us discuss what's on deck is J. Michael Print, CEO of the U.S. Polo ASSN, whose clothing brand is sold across most of those reporting earnings this week. Thank you so much for being here. Appreciate it. So,
hi, Julie. Thanks for having me.
Talk to us about the tea leaves and what you're seeing in terms of sell-through of your product and what it's kind of telling you about the state of retail right now.
Well, obviously, we've been watching retail very closely. In fact, I walked one of the big malls in the United States, actually one of the most important malls in Aventura. And I think what you're going to see is a very competitive holiday season. A lot of retailers have already executed their holiday plans. I saw deep discounts over the weekend online and in store from some best-in-class brands. So I think retailers are trying to get the profit margin dollars as fast as they can, knowing it's going to be challenging because consumers are strapped for cash. And I think you'll see deeper discounts as we get deeper into the season. What I will say, though, is I think you're going to have winners. I think you're going to have losers. And I still see a Walmart, a Costco, and Amazon having a great holiday season. I think great brands like U.S. Polo Aces In, where we offer working families and middle-income families a great price-to-value proposition, will be successful. And I think best-in-class retailers like Nike and Lululemon will also have a great retail. But it's going to be tough out there, and it's going to get tougher each day as we get deeper into it.
And Michael, you mentioned Walmart as a winner. Why? Why is Walmart going to be a winner in your opinion?
You know, they've got tremendous foot traffic. I think they offer the consumer a great price-to-value proposition, whether it's food or their apparel offering as well. And I think they've got a great management team. We work with them. They've been tremendous partners. And I think they have a really good game plan going into holiday. They're also investing $9 billion in their store of the futures for next year and thereafter. So if they weren't winning, I don't think you'd see that type of investment. And I think they've got a nice winning strategy.
What about on the higher end? I know you do less direct business with that, but I'm just curious what you're kind of the signals that you're seeing.
Well, I think throughout the year, you've seen the luxury consumer stay really strong. And the luxury brands have performed well. I think it's softened in Q3 at the very end. And I think there'll be some headwinds there. I still think your high net worth individuals are going to shop. They're going to spend money on luxury items. But I do think it could be softer for Q4 as those trends kind of continue coming in from Q3 as well.
And Michael, how do you see the lower income consumer right now? I think you mentioned you saw them as kind of cash strapped. I asked because the team at Bernstein, Michael, was just telling their clients that it now feels like we were in a low income consumer recession. They were pointing to things like savings, credit quality, deterioration, confidence. Is that how you see it?
Yeah, one thing about our brand, we have a $2.5 billion footprint across 190 countries worldwide. And like I say, we're a sports inspiration brand for working families, not only in the United States, but around the world. And I think one thing folks forget about thinking about a recession or challenging times is that a lot of U.S. brands also depend on international business, and we've seen it soften in Europe. I think China's a little softer today than it was 6 months ago. And when I think about the U.S. consumer, especially your point, Josh, at that kind of middle income down, working family down, gas prices are high, groceries are just unbelievably high, interest rates are high, we're all feeling inflation, all of us are feeling impact. And I think for those consumers, they're feeling it more than anyone else and have less discretionary income. So that's where I think brands have to be extremely strategic about how they're setting up their opportunities around holiday, around sales, and grabbing market share and those margin dollars earlier rather than later.
Is there anything, Michael, that stands out to you? As you said, you're a global brand. Is there anything that stands out to you outside of the U.S. right now as being particularly surprising in terms of strength, for example?
Well, what I've seen, India remains a great market for us. It's an emerging market. It's the world's largest democracy, 1.5 billion consumers. 50% of that population's under the age of 25. So we're a power brand. We're targeting $1 billion opportunity in India. So for us, it's strong. But I'll tell you, when you look at countries like in Western Europe, our partners over there will tell you it's very challenging right now, and they would consider themselves already in a mild recession in some of the key markets. So, that's one we watch closely. And I think China, the numbers have been soft throughout the year. We'll see if that continues. But I think the world economy's feeling some challenges out there with everything that we're all facing, not only in the U.S., but abroad.
J. Michael Prince, CEO of U.S. Polo ASSN. Thank you so much, Michael.
Thank you.
And coming up, closing bell on Wall Street, we're checking in on the latest market movers and the top trending tickers. Stay tuned.
Kyndryl, the IBM spinoff, ringing the closing bell on Wall Street today. Let's do a check of the closing numbers here as we close out this Monday. We finished with a mixed picture here with the Dow higher by about 54 points. That's not even 0.2%. The S&P down about 1/10, and the Nasdaq off by about 1/5% here. Not seeing a lot of direction here during the session, as we discussed earlier. People really looking ahead to CPI tomorrow morning, to retail earnings and retail sales data coming later in the week to perhaps set a little bit further of the direction. Utilities, the biggest drag today, along with real estate, those interest rate sensitive sectors. Energy, though, doing the best on the session.
And here with a closer look at the first trading day of the week, we have Yahoo Finance's very own Jared Blickery. Jared.
Thank you, Josh. Well, just taking a quick recap. As you said, a mixed market. Russell 2000 just barely in the green, and across the world, we're going to call it mixed. And here's a look at the 10-year. Just ended fractionally up, just 0.4 basis point, so hardly any movement there. Let's take a look inside some of the heat maps. Energy doing the heavy lifting, as Julia just said. Healthcare, in honor perhaps of Yahoo Finance Health Week, taking in the number 2 spot, followed by consumer discretionary, that is a retail sector, and then consumer staples. So retail really doing some lifting here as well. Industrials just barely positive. To the downside, utilities and real estates, those are both down about 1 and 0.8% respectively. Tech also down 0.6%. Might be some interest rate sensitivity. We did take a look at the 10-year, and it was barely unchanged. So hard to make that kind of connection here. But let's take a look inside the Nasdaq 100. We see Tesla, one of the biggest winners of the day. And in fact, that's up 4%. We got among the mega caps, 3 winners, 4 losers. Apple down 0.8%. So is Microsoft. Amazon down 0.7, and Meta up just barely 13 basis points there. And if we take a look at the EV space, in addition to Tesla, we have a number of winners here. Li Auto up over 6.5%, Rivian up 5%, Xpeng 2.5%, Lucid Motors 4%. So the Chinese stocks really outperforming there. And let's take a look inside the Chinese Nasdaq Golden Dragon China Index. And aside from some of the auto stocks that I just mentioned, Trip.com up 3.8%, NetEase up 1%. Do have a couple losers in there, like Alibaba down 0.5%. I was noting at the beginning of the day some weakness in tech, and we saw that continue throughout the day, except for NVIDIA and a couple other smaller ones down here. For the most part, the chip space looking at some red, taking a look at its cousin in the software industry, more green than we did on the last look at the heat map there. And then I'm just going to end on the banking sector, something I haven't really looked at much today. A mixed board there as well. Bank of America just barely positive. HSBC and Citigroup up more than 1%. JP Morgan down about 0.4%, guys.
All right, Jared, thank you for the roundup there. Let's take a look at some of today's trending tickers right now. We start with Tesla, the EV maker, adding a clause in its terms of service for those looking to buy a Cybertruck. In this contract, owners would not be able to sell or attempt to sell the truck within the first year of its delivery. Shares of Tesla are higher today. Unclear if this is exactly why the shares are higher, but basically what they're saying is if you buy a Tesla Cybertruck and in the first year you try to turn around and resell it, not back to the company, but to somebody else, that they can try and sue you and claw back what you get, the profit from that.
And yet I don't think diehards are going to be frustrated by that at all. I'm just very curious how this truck is received, because it's so, listen, it was designed to look different, and it is different. It has this sort of triangular look it's got going. I'm very curious. Also, remember what Musk said about it. And listen, certainly investors are excited. We've heard from financial analysts on this show. Julie, they're excited. Dan Ives, he's bulled up on the truck. But remember what Musk said on the last earnings call, said, I think this is our best product ever. Talking about the truck, ever, of course, ever, Musk, ever the salesman. It's going to require immense work, though, he said, to reach volume production and be cash flow positive at a price point that people can afford. So in some ways also maybe kind of downplaying expectations there, tempering expectations too.
Okay, all of that is true. Yeah. But why would they do this, right? Why would they say, you cannot turn around and sell this in the first year? There are a couple of reasons why. If you think about other products that you are not allowed to resell, maybe you bought it in the first place in order to resell it for profit. And Tesla wants to capture all of that profit. It doesn't want So I almost think of ticket scalping, right? Someone buys a ticket that is in high demand in order to resell it. The original company, Ticketmaster, Live Nation, what have you, doesn't want a third party to capture any of that profit. They want the profit,
yeah,
right?
I don't.
So is that what's going on here? Is there some sort of lack of confidence in the truck? It doesn't seem like it would be
I'm wondering if, do other car makers do something similar? Did I maybe sign something when I bought cars in the past, and I definitely did not read all the fine print. Maybe I signed something kind of similar. I'm not sure.
I would have to doubt it, but who knows? We need a lawyer on this.
We need a good car guy.
Or both.
Yeah, man.
Maybe we can find them.
All right, man, moving on. Shares of B. Riley. Let's look at this one. Financial continue to dive after S&P Global Ratings downgrades Franchise Group. Now, that's a company which B. Riley led financing for, a management buyout of that firm. So this one is interesting. It's a bit messy, but here's reading reports really what I can gather. S&P downgrades Franchise Group. And remember, Riley purchased a stake in Franchise Group, the company behind brands like Vitamin Shoppe, for example. So S&P reduces Franchise Group's credit rating deeper into junk territory. And they talked about weaker revenue, Q3 operating loss, high leverage, among other issues. And B. Riley, of course, took that roughly 30% equity interest in Freedom VCM Holdings, which is the indirect parent, from what I understand, of Franchise Group, and that's what we're seeing the reaction here.
Yes, we are also seeing the reaction because of this company, Franchise Group's association with a gentleman named Brian Kahn, who's the CEO of the company. Brian Kahn also is involved in a company called Prophecy Asset Management, and the co-founder of that firm admitted to defrauding clients of $294 million. Now, B. Riley also reported earnings last week, and in the earnings call, the head of the company said Brian Kahn didn't have anything to do with this, and this is not, basically said that this guy was not involved in fraud.
Right.
But because, as you said, this is a messy situation, so investors seem to be concerned. Whether that concern is valid is the company is saying it is not. But not only is the stock down sharply today, it fell 15% on Friday, and B. Riley shares are now down more than 50% since last Monday alone. So there's just a lot sort of swirling around this, and the company has not yet successfully gotten in front of that selling.
Not yet.
Yeah. All right. We got one more to tell you about. That is CrowdStrike, I should say. Stifel upgrading the stock from hold to buy, citing its cloud-based endpoint technology as a differentiator from other companies in the cybersecurity market. Shares of the company closing higher by about 2.4% in today's session. The price target on that going to 225 from 153, so pretty substantial upgrade to that price target.
Yeah, so Stifel takes us to the buy from hold. They say, listen, it's the leading provider of endpoint security, software, services, thinks the company's going to benefit from consolidation, they at least think's coming. And they think CrowdStrike can sustain at least low to mid 20% growth. That's their bogey. New products, international expansion. As you noted, the target goes to 225. Stock is up now about 90% this year. So listen, congrats to you if you've been long this time. 44 buys, 5 holds, no sell.
I mean, you could argue this is a little bit of a late upgrade, perhaps.
Perhaps, we'll find out.
I guess we will.
Average target is 200, by the way.
Got it.
All right, tech company NVIDIA is launching a new chip, the H200, continuing the company's investment into AI technology. But like some of its other products, it won't be exported to China. Here to talk more about unveiling of this new chip is Dan Howley, back again.
Back again. Yeah, I mean, this is a new chip from NVIDIA, the H200. Let me just go over some of the 200 stuff here. So there's the H200, that's the chip. Then there's the HGX 200 platform. That includes 4 to 8 H200 chips on its own. And then we have the GH200, which is the H200 chip, and then a Grace CPU. GH is Grace Hopper. They have the Grace Hopper super chip. It's their own CPU and GPU smashed together, and that's the GH200. They already have a version of this with the 100. But I think, one of the big things to point out here is that according to NVIDIA, at least, this has 2.4 times more bandwidth compared to the NVIDIA A100. Also important to point out is this is using what's called HBM memory. That's high bandwidth memory. It has 141 gigabytes of that. What does that mean? Well, the more memory you have, the more you can cram into these kinds of chips and processors, and that means you can run larger AI models. But worth pointing out, AMD has its own chip that has more memory than this new NVIDIA chip. Now, that's the MI300X. Just throwing it out there, the X on there. Those chips are going to be start shipping later this year. The big deal here is NVIDIA still has a huge lead when it comes to AI chips. They're going to hold on to that. Anybody that I've spoken to has said, look, it's going to take quite a while for companies to catch up to what NVIDIA has to offer. It's not just their silicon capabilities, it's how they put their servers together. They've purchased so many companies along the line that fill into this space. And then on top of that, it's the software as well. So, when you're a company that has from the silicon to the software, you can control everything in there. And so if you want to improve the capabilities of one piece of that, you can go ahead and do that. You don't have to call another company and be like, hey, can you fix this? I need, XYZ for my software or whatever. You just say, Charlie, go do it. I don't know who Charlie is. Maybe he works for this company or I don't know. But that's kind of the key here. And so you can think about it the way Apple does things with their own chips, right? They put it into their iPhone so it's better. So that's the idea here for NVIDIA and why they still have this lead and why they will probably hold on to it going forward.
I feel like we need like an alphabet soup graphic, like a bowl of soup with all the different, I know it's not apples to apples at all, but we recently heard from Qualcomm, which had introduced what it says is a much faster chip. Now that was a CPU, not a GPU chip. But when these various companies, particularly the chip makers, come out and say, our new chip does X, Y, Z, how do we find out? Is the proof just in the market and what the uptake is? So when NVIDIA comes out and says, this chip is going to have this much AI computing capacity, is it just, do we just find out when people start buying it and using it?
Basically, you'll get companies that will buy them and then benchmark them. It's kind of the same way as, like, I would buy an Intel chip, right, for my desktop computer that I would build, right? I would then benchmark that using some kind of freeware apps out there. I do it because, I play games and I want it to be great. They'll do that with these chips as well. They'll run similar benchmarks and they'll say, this is better here, this is better there. And then if it's, good for NVIDIA, they'll publicize that probably and, say, hey, this third-party company had said we're X better. Intel will do the same thing with their Gaudi chip. AMD will do the same thing with their own chip. So they're all going to go around and constantly say, we're winning here, we're winning there, we're winning over there. The truth is NVIDIA is just doing this, and they've been doing it longer, so they have the expertise to be able to stay ahead. Like I said, they're gonna stay there for a little bit. NVIDIA and AMD, Intel and AMD trying to catch up, and AMD has that GPU expertise that they got when they bought Radeon years back, so they still can do that. Intel trying to work on its own GPUs and continue to put that out. They have the expertise with the CPUs. That's a big thing to keep in mind. NVIDIA's got the GPUs. That's great for AI. You can't have a GPU run on its own. It needs a CPU, and that's where Intel comes in. So whenever we talk about AI, they don't have the GPU side, but they still, all these companies need these CPUs, and they need Intel for that.
Dan Halley, and we need you to help explain all this stuff to us. Appreciate it. Thank you. Well, coming up, Airbnb named a top stock pick for 2024 at Bernstein. We'll tell you why next. In focus ahead of the holiday season, travel demand. Bernstein out with a note today naming Airbnb a top stock pick for 2024, saying top line growth should accelerate. And it's sort of interesting here because the note acknowledges that we will see some moderation of travel trends here, but that basically that this company is still going to see accelerating growth even in the face of that.
Yeah, I mean, one, he sounds constructive on kind of travel overall. He's talking to his clients about, listen, the high-end consumer keeps spending. We've heard that from a lot of different analysts and economists. Two, he's banking on Asia continuing to recover, he says. And then kind of also limited hotel supply growth, he thinks, preserves that pricing power.
Right. In particular, the emphasis here, even though he's sort of bullish-ish on travel, really that bullishness is centered within lodging specifically, that is going to be the area in part because of the supply-demand dynamics that you mentioned there that should help. And of course, it's not just about the U.S., the obligatory Taylor Swift mention in the note here with regard to European
Can't do a show
travel,
without it at this point.
that there's going to be a Taylor Swift tour that will support things there, as well as the Olympics, football championships, that there are events happening in Europe that should help the lodging sector in particular there. And he says even if the macro environment worsens, that again, lodging should still be the subsector within travel that holds up better.
And it's interesting, remember they reported earlier this month, Julie, and they report, it was kind of, the outlook was somewhat muted and soft relative to expectations, and the commentary around demand did sound kind of cautious. The key line from the company was that we're seeing greater volatility early in Q4 and are closely monitoring macroeconomic trends and geopolitical conflicts that may impact travel demand. But listen, bulls are willing to look through that.
Yeah, so a couple of the other calls that are part of this, a bigger call, Booking.com getting upgraded to a market perform. And the analysts here, and the analysts, by the way, are led by Richard Clark here over at Bernstein, this team that wrote the note, acknowledges that they were late on this, that the stock has already had some decent upside, but they're still going with market perform on this one. TripAdvisor going to an outperform from the equivalent of a neutral rating at the firm. So those are the other calls that they're looking at and how the kind of lodging universe looks for the company.
Is the Julie Hyman family Airbnb fans?
We've used,
Really?
on the trip that we just took, we used.
You booked an Airbnb?
Airbnb, yes.
Right.
Are you not an Airbnb family?
I had an experience which I have to talk to Chesky about. I took the wife and the kid and the dog to an Airbnb in Santa Cruz. And I gotta tell you, there was a hairball under that bed, Julie. You could have put a leash on it, and we had to cut the trip. I just knew in that moment, I think I'm a Four Seasons guy. You know what I mean? I think that's it. Yeah.
God bless you. All right. Shares of Plug Power extending their losses today after plunging 40% on concerns about the hydrogen fuel cell company's future. The firm warned about a going concern last week, saying there was substantial doubt about its ability to continue. But CEO Andy Marsh brushed those concerns aside today, telling Yahoo Finance's Akiko Fujita investor concerns are overblown.
First, we have over $500 million of cash available to us. We have a balance sheet that has $1 billion of restricted cash. And we have a balance sheet that has $1 billion of inventory that's really there to support our growth in the fourth quarter. For about 6 months, we've been telling the world we will be looking at different solutions to allow us to get through the next year. When I look at it, we feel very, very confident that we'll be successful. And look, it really is the company that came out and said, hey, this is a going concern. This could be a going concern, not the auditors. The companies did an analysis of how much we expect to spend the next 12 months. We saw a gap probably somewhere around 500 million, but that's 500 million if we do everything we say we're going to do. We feel pretty confident when we look at everything, when we look at our ability to manage through this, that we're going to be fine. And I can tell you, there has been, I've had term sheets which are well over that amount of money. And we're talking to folks about opportunities to raise cash much larger than what we need. And we're just trying to do it prudently so that our investors are in a good position in the long run.
Andy, when you say you're looking at different options, a different solution, you mentioned a potential capital raise. How much capital do you need to raise?
So at Kiko, a capital raise could be debt too, right? So as I mentioned, our analysis would show that in the next 12 months, we probably need to bring in $500 million. Some of that, I have actually different ways to raise that money. And, I feel very, very confident. Some of that $500 million, when I look at our partners who are looking to leverage ITCs, could cut that number in half. And when you look at our restricted cash of $1 billion, you can almost say, hey, I have people who are willing to lend us money against our restricted cash.
Andy, let's talk about how Plug Power got here.
Yeah.
As we've talked about in the past, you're talking about a space that is very capital intensive. And I wonder how much of this is about the debt load you took on exacerbated by the higher rate. How much of it is about the volume constraints you've been facing?
So at Kiko, I have zero debt. I have a $5 billion unleveraged balance sheet. I think that puts us in a unique position to be able to raise debt. So, we may slow down some of our plant activities, past, we have Georgia coming online, we have Louisiana coming online. We may slow down other plants after that, but, and which would reduce our capital needs. So, that's how we look at it. And look, if the market was growing a little bit faster, it would be easier. But also at Kiko, I want to be really clear. We've been dealing with a hydrogen shortage. And I made this clear during our earnings call that, there has not been enough hydrogen in the US to support our needs. And we've done an extraordinary job to make sure our customers have hydrogen all the time. And we've been moving hydrogen from the West Coast to the East Coast. And we really expect that as our plant in Georgia come online, that relieves a lot of the pressure that Plug is facing.
What does that timeline look like right now?
I expect, and I've been really clear, by the end of the year, and I'm on calls every day, and we're making great progress. Into 23. Yeah.
Having said that, Andy, we saw shares plunge to levels we haven't seen in nearly a decade. What do you think investors are missing right now? If you're so optimistic that this can be resolved, why do you think the market sees it differently?
Well, I've talked to 3 large firms that I deal with every day. And I said to them, sometimes people overreact to good news. Sometimes people overreact to bad news. And the truth is usually somewhere in the middle. And I don't think people have really focused on, and I've seen mistakes where people don't realize that there's $500 million of cash and liquidity on our balance sheet today. I've seen analysts miss that. I've seen investors miss that. And I think that maybe folks have been reading headlines instead of really digging deep into the details.
So the long-term demand for hydrogen, as you've laid it out very clearly publicly, does that still hold? Does that vision still remain unchanged for you?
So at Kiko, absolutely. And look, if you look at the world, if you have a fundamental belief that the world has to get to net zero, there's not a model around that doesn't suggest hydrogen needs to be at least 14% of world's energy, if not 24% of world's energy. So, will we, is this a bump on the road? I'd be disingenuous if I didn't say this has been a bump on the road. But we have strong demand. My major customers have been more asking me how they can help me. And when I explained the situation we're in, and I think people who are close to Plug, which quite honestly are customers more than investors, because customers see what a difference our products make in their operation. They're confident that this hydrogen economy is going to grow, and they're confident that Plug's going to be a leader in it. Nobody has the facilities we have. Nobody's built out the product lines we have. nobody's building plants like we've done. So I just think that the market will catch on. I think the clean energy sector obviously has taken a huge hit. I think ultimately the market will come back, and we continue to be in position, and we continue to be laser focused on how to build out this hydrogen economy. And look, Kiko, we're going to do it prudently, but we are laser focused on being successful.
Finally, Andy, just to clarify here, when you talk about the volume constraints that you highlighted in your earnings release, you're saying that this Georgia plant coming online will largely resolve much of that?
Yes. It will resolve.
Right. Andy Marsh, Plug Power CEO, really appreciate you joining us today. Thanks so much.
Well, thank you, Kiko.
That was our Kiko Vegeta with CEO Andy Marsh of Plug Power. Coming up, Disney's latest flop, The Marvels, has the weakest U.S. debut weekend in MCU history. We'll break down what it means for Disney next. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance Live. Josh Schaefer here with Alexandra Canal and Pras Subramanian. And welcome into the Yahoo Finance group chat. New studio,
new look,
new
name.
New name. We're breaking down 3 things that caught our eyes today in the group chat.
That's the real name?
Group chat.
The group chat.
I didn't even know about that.
We got to add you to the chat.
All right. Yeah, I'm not in the chat
Add
yet.
him to the chat.
Well, one story you missed in the chat today, Pras, was a story out on Warner Brothers Discovery. So Guggenheim analysts today out with a note saying that they think that Warner Brothers Discovery could be in to maybe buy Fox or Paramount. They put those as the 2 most likely possible targets. The key reason they think that Warner Brothers Discovery would be interested in such a purchase would be to get access to the NFL. A big part of sports streaming, obviously, and Warner Brothers Discovery, one of the only big names that does not currently have exposure to the NFL. So sort of Guggenheim analysts saying here, well, maybe Warner Brothers Discovery needs to get into that game because NFL viewership, as you can see on your screen, at an 8-year high, one of the most watched things on television overall, and of course, the most watched thing when it comes to sports. So them basically making the case that for a turnaround story of some level at Warner Brothers Discovery and to get people to stay on the platform, they need the NFL. Allie, you're the streaming expert. Overall, thoughts?
I just do not think that WBD is a buyer. I think if anything, they could be gobbled up by a bigger competitor like a Comcast, for example. I could see Comcast going and buying Warner Brothers Discovery. In terms of WBD purchasing Paramount, I don't see that happening either because Sherry Redstone has always said she wants to sell Paramount altogether, right? So Paramount has CBS, so I can't see Warner Brothers Discovery, which has CNN, wanting CBS. I just think it's too complicated. And yes, we know the NFL drives viewership. We know the NFL is very important when it comes to sports watching overall. But WBD has NBA, which those rights renewals, that's coming up. That's going to be a big thing to watch for how that gets divvied up, especially with streaming. I'm just not convinced of this note. I get it. I understand that Warner Brothers Discovery probably needs some exposure to the NFL.
Well, I mean, look at the viewership, right?
Yeah.
When you look at the viewership graph that Guggenheim published in this note, it's pretty eye-popping when you take a look at NFL national games, NFL regular season games, how much higher that is than basically every other sport process. I mean, Allie mentioned the NBA. Look at how much lower the NBA is in terms of viewership.
Yeah, we were talking about how I was surprised how the NFL national game, a national game on a Sunday, does more than an NCAA men's basketball championship, right? Absolutely insane. But kind of what, taking on what you're talking about, how like, can WBD even do an acquisition given their debt load? Right? It's an enormous amount of debt load. Looking at Paramount and Fox, so Fox worth about $13.9 billion without any debt. Paramount $8 billion without any debt. I mean, those are big acquisitions to make if you have so much how much $50 billion in debt? Something insane that David Zaslav and all his buddies kind of levered up on Warner Bros. Discovery. Zaslav did say, though, on the earnings call that they have good free cash flow generation and a strengthening balance sheet that can allow them to do, quote, a chance to be really opportunistic over the next 12 to 14 months. So maybe that's sort of why this note mentioned that. Also, they all said you don't need to get full Fox, you need a portion of Fox, the sports part of Fox, right, or the network part of Fox. You don't need to get Fox News and everything else, the studios, leave that alone.
Yeah, look, I agree that media consolidation is going to be happening across the board. It's just a question of who are the winners and losers, who are the buyers here, and I'm just not totally convinced that WBD is a buyer, but we'll have to see what happens.
I think the last point I would point out here that we sort of got at is just thinking about NFL rights and getting access to those, and Guggenheim making a great point that those are largely already taken away for the next 10 years, right? NFL rights in general, unless they add more games or sort of do some kind of contract breaking deal, we're pretty locked up for the next 10 years, including that Amazon Thursday Night Football game. So just to get access to the NFL, if that becomes something we're talking about more in the streaming space, you're going to have to see some form of consolidation or some streamer paying another streamer to get those because they're already tied up.
Yeah.
Which is interesting.
Or just go to Europe. NFL Europe.
NFL
There
Europe.
you go.
In
You
Germany.
can expand abroad.
Well, speaking of sports, we know Disney has ESPN, which obviously Disney, ESPN, great match. ESPN, the worldwide leader of sports. But right now, the company seems to be struggling at the box office. We saw the latest Marvel movie really tank, just $47 million in the debut versus the expected $80 million that was expected. In fact, we haven't seen an MCU film that's opened lower than $60 million since 2015's Ant-Man and 2008 Incredible Hulk. Now, Disney and Marvel, they've really struggled to connect with audiences post-Endgame, which came out in 2019, and it calls into question what the company needs to do moving forward to really solidify the studio side of the business. And Bob Iger, he's consistently preached we need quality over quantity. I think a big issue was that during the Bob Chapek era, they wanted to get as much content out as possible, both on streaming with Disney Plus and at the box office. But I think that muddled a lot of the consumer perception, because when you have all of this content, a lot of it you can watch in the comfort of your own home. Right. What does that mean when it comes to the box office?
My two thoughts were kind of similar to that. Is that we have Marvel fatigue, right? You have so much going on in that world that universe, that cinematic universe is so vast and rich, and for fans, it's so cool to kind of find the little wrinkles where you can with little characters. But there's so many characters, I can't keep track of it. You mentioned Endgame. Endgame was huge. When that was over and you lost like Captain America and people like that, where do you go from there? I think that's the struggle right now. Where do you go with the Marvels and whoever the characters are in the new movie? I think it's hard to sort of judge that. Also, 62% Rotten Tomato score, not great.
Yeah,
reviews
it's not a good movie.
hurt
I mean, that's look, if we're calling this segment the group chat now, the reason we're talking about it is because it wasn't in our group chat, right? Did anyone tell you to go see this movie? Have you been hearing about this movie over the last 2 weeks? Think about the popular movies of 2023, right? We were talking about Barbie, we were talking about Oppenheimer, which obviously wasn't even nearly as big of a release as Barbie, but that was in your group chat. People knew what it was and were talking about it. What do those two movies have in common? They're not some form of remakes relying on characters that people already kind of know or in a universe that people already know. They're vastly different.
Yeah.
We've been talking all year about how you need something different to get people to the movies now. And I think Disney just needs to wake up to that a little bit, that yes, Marvel has been very successful, and it might be successful on streaming and when you build shows out for it, but to get people to go to a theater and pay $15 or $20 a ticket and take time out of their weekend to go do it, you need a little bit more right now, I think.
Yeah, and you need to be more strategic when it comes to the lineup too, because I was speaking to some analysts who said if you look into next year, there's no major sequel, right? For even some of the animated titles like Frozen. I'm sure a Frozen 3 would crush it in the box office. So it's not necessarily that the sequel is dead. It's that you need to be more strategic in what you are spending money on in order to make sure you're getting as much as you can from these movies. Because at the end of the day, if you spend a lot and it flops, that's horrible, and it's going to feed into your bottom line. And analysts have told me they don't think the theatrical side of Disney is going to produce anything meaningful over the next 12 to 18 months, because it's going to take a very long time for Bob Iger to really reset this part of the business.
Yeah, I mean, they paid a lot of money for Marvel back in the day, so how are they going to recoup that? Maybe it's through new characters like potential Elon Musk superhero. I don't know.
Joining the MCU, Elon Musk.
Yes. So we're going to stick with movies and not superheroes here with Elon Musk. So apparently the Musk biography penned by Walter Isaacson is going to be basically made into a movie. A24, the super hot studio, is going to do this with apparently Darren Aronofsky, director du jour, director auteur, Requiem for a Dream, The Wrestler, Black Swan, The Whale, among others. A true director's director. So much so that Musk tweeted about this news and said, responding to it, saying, quote, "Glad Darren is doing it. He's one of the best." So good thing that Musk is happy here. But the question is I have seen this movie because of work, probably. You guys, maybe. But also, who's going to play Elon?
That's a big question. When I first heard this story, I said, you know what? Elon Musk should be played by himself. Like, I could see him getting some acting
It's a quick way for me to not watch the movie. That's like an instant way I don't watch the movie.
And then realistically, there's some funny things floating around on the internet. There's Rami Malek, potentially. We were talking about it in the newsroom. Christian Bale.
Christian Bale would be good. Like, Christian Bale, I was going to say, he's a great actor that can, like you said, sort of method act in a way and get into someone's head. And if you could talk at that pace of Elon, and I think that could be interesting. Nick Cage would be funnier. I like that one.
And it could be Nick Cage, his comeback as Elon Musk.
I mean, I like Rami Malek. I think it's a good, safe choice. You got people like Michael Fassbender who played Steve Jobs, right? I don't know. That might be pushing it, but I think Elon Musk playing himself is too hilarious.
Probably.
It's too funny.
He's gonna make an appearance. He loves himself so much that he's gonna be a featured guest of some sort, even if it's behind the scenes. He's making his way into this.
Is it too early for the movie in his career? When you think about the fact that, like, say the book's coming out, right? The whole X thing isn't really even in the book.
Yeah.
I mean, look at The Social Network with Zuckerberg.
That's true, which is one of my favorite movies.
Pre-metaverse.
Yeah.
It's only about Facebook. It's not even about Meta.
Yeah, I know. Not even that.
All right, well, we'll keep debating who could possibly play Elon Musk in the group chat. But coming up, Yahoo Finance's week-long special healthcare industry checkup is continuing on the other side. We're taking a look inside the world of medical misinformation. That's up next.
As part of Yahoo Finance's week-long special healthcare industry checkup, we're taking a look inside the world of medical misinformation. Yahoo Finance's Anjali Kamlani had the chance to dig into how YouTube is elevating its reach of quality health information with Google Chief Clinical Officer Michael Howell, along with Dr. Garth Graham, Global Head of Healthcare and Public Health at YouTube and Google Health. Take a listen.
Yeah, as a doctor, you know in your heart that the right information at the right time can help someone's life be unbelievably better. And so we have teams working to lift up the best quality information all across the company. One of the shining examples of this is YouTube, that's been working on it for a number of years. And we work to lift up high quality content, even as we work to lower and make less prominent content that isn't accurate or helpful to users.
And what is the way that you're doing that? What metrics are you using, and how are you going about doing that? Garth, if I could get you in for that.
Sure. Yeah, Andrew, we think of it like a garden. How do you weed out the information that's bad and dangerous for users in the community? And how do you lift up and plant the seeds of good information for people so that people are able to make the right decisions at the right time? So, we're an open platform, but the real goal is how do you balance getting good information to people at the right time, as Michael said, while making sure that we remove delicate or dangerous information.
And I know one of the ways that that's being done is to kind of emphasize verified, credible sources. We're talking about universities, governments, hospitals, even especially when it comes to the science and health information. Michael, can you explain to me how that was really envisioned and how you're maintaining that? What went into ensuring that this is how we now see information?
Yeah, I'll start and then Garth can lean in. So we don't want to be the people deciding. So we worked with groups like the National Academy of Medicine to define the key aspects of what makes something a credible source. And then Garth and teams that Garth work with began to operationalize those inside of YouTube. So things like if a person is credentialed to treat you as a physician, they're probably likely to have better quality information. And so being able to operationalize that and lift those up is one of the things that's been the work of years. And Garth, you may want to add things.
Yeah, and Angela, the only thing I'll add is, we're really the first to really start labeling health information as coming from licensed doctors, licensed nurses, licensed healthcare professionals. So really this idea of identifying that credible source based on the National Academy of Medicine, World Health Organization definitions, and then raise that up so people know who they're getting information from and that they can trust that information.
And I wonder if you could respond to, there are going to be some people who might push back and say, to your point, Michael, like, who are you to determine that? And why should we then trust that you, Google, you, YouTube, are the arbiters of the information we are then supposed to accept as trustable, verifiable? We've seen that has been sort of that underlying trust problem is the key to this.
Yeah, and to the point that Michael said earlier, that's why we rely on the National Academy of Medicine that has made the decision around very complex health policy questions for the country, bringing together the world's experts. So it wasn't us that was saying that, we were relying on them. And then we just ingested those into our system. So I think, that concept of how do you rely on the experts to help identify high quality sources is something that we relied on heavily.
And tell me, Michael, sorry, go ahead.
One of the things about the way that YouTube has handled it is it's very transparent. This channel is from a hospital or from a national health authority or from a physician, and then lets people link out to find more information about the criteria. And so it centers the user in being able to control and understand what's going on.
And Angela, let me just riff off the transparency point. One other point, this whole process was transparent. It was put out for a public comment. People could see. There were webinars. So we really tried to make the process very, very transparent for people to see.
I wonder on that. So the way that I understand that, these are being presented is sort of like an additional ribbon at the bottom that kind of emphasizes if someone is searching for a topic, then they're guided towards these additional resources. How did you get the buy-in from sources like the government, which traditionally wasn't really doing much video? How has that relationship been? What conversations have happened to get them in the fray?
Well, quite frankly, we've seen the whole healthcare ecosystem be energized around reaching people with health information. So not just the government, but hospitals, physicians, local health authorities around the world, really have been proactive and stepped up. The World Health Organization and others around really trying to get quality health information to communities at scale.
And does that include, Michael, maybe encouraging them to make videos or working on topics that you see, on Google search kind of trending, and then having them maybe suggest that these are videos that they should be putting up?
One of the things we've seen is this emergence of a creator community of physicians and nurses and licensed mental health professionals. If there's no good content out there that people want to watch, it's very hard to show that content to users. We've seen people really respond to that on their own and through partnerships that the YouTube Health team has led.
You make a very good point. We know that during the pandemic in particular, we saw the rise of the trending, the influencer doctors, if you will, sharing information. When it comes to those individuals, do you have, sort of influencer relationships with them in terms of being able to, recommend topics and the like?
Well, we're very supportive of the clinician community that has been present on YouTube. And, what we try to do is to make sure that, as I said before, we're able to kind of make sure that people know that they're licensed and qualified and that these are the kinds of voices that, are more likely to present evidence-based information. So, we highly value our clinician creator community across the spectrum. And really, they've stepped up to the task of getting high quality information out to the community.
And what has been the response so far? Have you seen, broader engagement, better engagement with this content that you're trying to promote?
Well, we see, Mayo Clinic the other day passed 1 million subscribers. So, you're seeing where by creating high quality content, people are engaging and people are coming to these sources. So they're a good place for them to get not just their clinical care, but good health information as well.
Our thanks here to Michael Howe and Dr. Garth Graham, and of course, our very own Anjali Kamlani. Be sure to tune in tomorrow for more on Yahoo Finance's special Healthcare Week. And coming up, what to watch on Tuesday, we get you set up for everything you need to know tomorrow. Stay tuned.
Here's what you need to watch tomorrow. On Tuesday, we get the Consumer Price Index data. It will offer a key update on the central bank's fight with inflation. Economists forecast headline CPI rose 3.3% over the prior year in October, a decrease from the 3.7% rise seen in September, mainly driven by a drop in energy prices. It comes as Fed Chair Jay Powell casts some doubt on holding rates steady in the coming months. He made those comments last week. But we may hear otherwise as we expect lots of Fed speak in the next few days, including from officials John Williams and Michael Barr, among others, tomorrow. On the earnings front, Home Depot is going to kick off a week of big retail earnings. Investors will be looking for an update on the health of the U.S. consumer as the holiday shopping season kicks into high gear.
That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there is more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.